Well, good morning, ladies and gentlemen. We're looking into the office market now, which is the biggest market segment in the German real estate market, and probably the easiest one for an international investor to get a foot on the ground, because it's probably easiest to understand and the easiest to handle. And Germany, we have heard it, is seen as the safe haven today. Germany's exports are doing fine. We have a low interest environment which seems to persist. And rental levels in Germany are comparatively moderate. So it's a good basis for a market entry. However, the cycle has run now for a number of years. A lot of investors are present. The German investors themselves are pretty strong, and the yields have considerably compressed. We have to acknowledge that Germany has always been a low yield environment, and that's part of a stable market. The federal structure makes it difficult to understand the market, so this is what we're going to assess today. So with other words, at the moment, we see little product in the market, and we have the risk of overpricing. There's a multitude of cities which you need to understand, so it is actually not easy to enter, and the question is it still the right time to enter, or have you missed the right cycle? Today's panel will give you all the answers to those questions and present you partners who would be the right ones to team up with to manage successfully the market. Given the time constraints of this panel, I would like to keep introductions very short, and I advise you to contact the panel members during the breaks and during the whole day. Briefly on myself, I'm based in Hamburg. I have been with an open-ended fund for 15 years in Germany. I'm managing a special fund today for German insurance companies and do asset management on a separate account basis. I do strongly believe in Germany, and I think there are opportunities you can work on, which you can manage. But bear in mind, Germany is always a long-term decision. It is not a market where you can flip quickly. Let's have a quick introduction of the panelists first. Please, Stefan, why don't you start?
My name is Stefan Boehme. I'm heading a company called s.boehme & Co., which modern times everybody calls it family office. We would call it more like a wealth management company, focusing purely on real estate. My background, and that's only for private individual families. So far, German families which have an entrepreneurial background, most of the time they still have their company, and they want us to manage that wealth on the real estate side. And my background, and that plugs in a little bit in that, is I have been for many years working for the family of Friedrich von Metzler, which is the bankier Metzler known from Frankfurt, and also was managing director in the Bankhaus Metzler for US real estate. So I have a little bit both experience I would like to bring to the table of both institutional money as family office money. Today I would rather take the perspective of the family office money.
I'm particularly happy to have James Knox here, who comes, like you, from an RICS-dominated civilized environment and who has taken the advantage to work in Germany for a number of years. James.
Yeah, good morning. My name is James Knox. I'm a partner in the law firm Berwin, Leighton, Paisner. For 20 years, I've worked for German investors investing outside of Germany, and for 10 years or so, worked for international investors investing into Germany.
Douglas.
Doug Edwards, Managing Director, Corpus, Sireo, responsible in part for the fund management business out of Luxembourg, but also head of all the international clients into the German market. Background, I have been, when I was at AXA and at Daddy Hansen, a direct investor in Germany, so I have both sides of the coin, both from a direct investment viewpoint as well as from an advisory asset management viewpoint.
And we have Torsten Hollstein.
Torsten Hollstein, one of the partners in Sireo Investment Management, a pan-European investment manager with a strong focus on workout situations, very granular situations with prior experience in private equity and investment banking, based in Berlin.
Stefan, you have concentrated in the past years on investing in very prime assets in Hamburg, in Düsseldorf, and in Berlin. Is there still money to make in that segment?
Well, one step back and then I answer your question. The role the money plays for this family is obviously balancing off their corporate risk, and that's why capital preservation is the main key for them. And I'm benchmarked, first of all, for capital preservation, and obviously trying to bring assets in the next generation. So there's a long-term view while acting opportunistically. So there might be long-term strategy, but still there's entrepreneurs, there's changing things going on, so we have to always be liquid. And because of this liquidity and this need for fungible markets, we actually are one of those mentioned earlier who only concentrate on the top 5 to top 7 cities. I'm originally coming from Heidelberg, which is a strong region, and Mannheim and Karlsruhe and Darmstadt, very prosperous region, and residential market is incredibly good. Myself, my family, focusing there on residential. And anytime I put something forward, they say, thank you, excellent, but let's move back to the table. So the idea is really about capital preservation and staying in this very liquid market, and that comes always back to these cities. Now, back to your question, this has been for us for quite some time very good locations, and I have to admit that just over the last 2 years it has been increasingly more difficult to put money down. And in this sense we have shifted our strategy for defining prime as only the location being prime, ultra prime, but whereas the asset was in the past also like to be a ready, done deal, everything is fine, nothing has to care for. We are really working hard today. We're sweating basically with our team to get the assets done. We would have had Dr. Rüdiger von Stengel today here, who actually has this term manage to core, and we obviously didn't come up with that term, but we are working with this term internally to really have to work on the locations to make it work. Otherwise, we would not be able to hit our returns. And so I would suggest, yes, these places are still good if you have that goal. If you have a longer term horizon and at the same time your structure allows for opportunistic actions, I think it's a very great market, Germany, and I would emotionally advocate to go to Germany for this reason, especially if you are have a money which you have capital preservation attitude in it. At the same time, there are new players coming in who want to buy suddenly your assets for a great price. So you have also sometimes, not always, like in London, but you have sometimes really good selling opportunities. So for me, the question is not this market; it's more how do you come into this market and how good you do your due diligence or choose your managers to work with.
Torsten, can you help us with the definition of markets? We're talking about top 5, top 7. Some people talk of the top 3, just Berlin, Hamburg, and Munich. Plus, also there is, I have heard that there must be an office market in secondary cities in Germany. So where do you have to go, and how small shall a city be for an international investor?
So first of all, for the office markets, the definition of the 5 or 7 cities is not different to the one that we've heard and seen from Peter earlier on for the residential market. I'm glad that another word has been mentioned by Stefan, which is liquidity. And if we look at the markets and if we look at investors and where should you go, you should look at what's the money that you would like to spend and how is your investment horizon. We are looking at the 5 big markets and the 7 markets who are very liquid, where you have the investment interest of German institutional investors, German private investors, and international institutional investors. But then if you leave that core element, you can rule out already a few of these market participants if you go to the next 2 cities, or if you go further We've heard the figure already that there are roughly 100 cities. I think it's even more with more than 100,000 inhabitants. So the more you leave these markets which are known internationally and where the investment community has a network already, the smaller the group gets. And this is, of course, important for everyone in the acquisition phase, but also for its exit. And this is, we think, one of the important things combined with a difference in price. If you look at what you can buy for a given amount of money in London and you want to spend the same amount of money in Germany, you get considerably more stones. And as this means you have a much bigger effort in spending the money, you need to buy more properties, and this means look at how liquid is the market for you to acquire, and the same thing true the other way around, how liquid is it if you want to get out of it. So very important from our point of view that you look at how big is your purse and how are you looking at also your exit market and horizon. And that's what we've just heard already. You are surprised that you get very good offers on some of the properties which you find already high in value, but it's a liquid market, so people come. Now, if we look at selling in those markets, as we do this quite a lot, what we find is it's very difficult for an international investor community to buy in these smaller markets, because unless there is a specific reason, experience, etc., you don't have an established network of international advisors whom you know, with whom you can communicate in these smaller markets. This means that very often the local investors are quicker in making the investment decision, and they're more convincing than to the local banks who finance it and to the local authorities with concepts which they want to implement. Can't overstress this, because if we look at roughly 150 properties or so sold over the last 12, 15 months in secondary and tertiary cities, it was very, very rare that the international investors community was able, even if they were willing, to come up in the right time frame and with the right price and concept to win such a mandate or such an acquisition.
Okay, so that's a very interesting point. Douglas, Germany's office rents are very low compared to London or Paris, or even other global markets. You see the potential for German office markets to hook up with Paris and London or other global standards?
Well, the simple answer to the question is no. Fundamentally, the reversionary rent in Germany is very low. Therefore, the relationship between contractual rent and sustainable rent is nearly balanced. So therefore, I would expect only moderate growth in the core markets. That's the top 7 markets. We have seen up to the IPD, which came out in May, saw about a 3.38% growth. I see that growth mitigating somewhat in the later part of this year, basically because quality of space availability isn't in those marketplaces, or they've been pre-let already. 70% of new space is already pre-let anyway. So from my perspective, rental growth in the core cities will be moderate to limited. Where I have a slightly contrasting view in the regional markets, I see growth of rent in those markets far better. I see rent moving towards 2 to nearly 3%, subject to which of those markets. We do, I think you heard my colleague talking about a regional office index. We have seen a sustainable rent increase in places like Hanover, in Erfurt, in Nuremberg, where we've seen sustainable rents far better than the top 5-7 cities. So one of the points I would say is education on both the leasing and on the rent basis, let alone on the liquidity. The other thing I would also say, we're beginning to see from our leasing activity a greater requirement on TIs and giving away rent-free. So we're beginning to get more of a tenant-sensitive marketplace at the moment. And I think that's something which we're looking at. Also, the structure and nature of leases are beginning to change as well, and possibly from a legal perspective, that might be an interesting angle. But I think in general, the answer to the question is no. We will see some small growth. We will see out of the big markets, Frankfurt, I think, and Stuttgart will not succeed in terms of growth. But I see Hamburg and I see Munich possibly being the best performers in the coming year.
Right. Well, Charles Kingston has confirmed already that Germany has professionalized in the past. James, can you confirm that? And what is your experience during the past 20 years?
I'd say rather than the last 20 years, I'd sort of pick on the last 10 years, because I think really it was about 2003 that quite a lot of the international investment into Germany started. Mainly that was multifamily, so that's not this session. I think the experience of office investment into Germany from international investors was more around sort of 2005 onwards. Again, this is very much an external view, but I see the open funds as quite critical to this, or rather their crises that they've had since 2005. In 2005, 2006, for various reasons, a large number of the funds sold off big portfolios, which brought international investors into Germany. And then there have been further crises following the financial crisis, where some open funds are effectively being closed down and their assets being sold off over a period of time. That brought a lot of international investors, often doing debt-fueled deals, into the German market in 2006, 2007. And that in itself, at least from a lawyer's point of view, has been a good thing, because it means that the market's made up of all sorts of investors, people investing into prime property through to people in some trouble, having done some rather highly leveraged deals in 2006, 2007, and now in some trouble. But I think in any jurisdiction where you get an influx of different nationalities and different skill sets, it can only be a good thing, in that it sort of broadens the knowledge and makes assets and the way deals are done more international and also more familiar.
Okay. Stefan, you were talking about, or mentioning the phrase managing to core. What are the basic ingredients which always have to be there from where you can go to core, or where can you deviate? And a specific question, would you consider green as the new core?
Say it again, the last one.
Would you consider green?
Green.
Is
okay.
green
Yeah.
is
okay.
green building, does that compensate for
Yeah.
other core ingredients like location or tenant structure or whatsoever?
Well, for us, core starts really at the site. One thing you cannot change, everybody knows this in this room, is the site and how does it develop further. We invested, for example, in Hamburg and in Düsseldorf, right next to urban developments, where we saw clearly this, this place will be changed massively by the city or by major developers. We did this also in Boston, where we clearly saw there's something happening to the right. You don't know about 10 years, 20 years out, but you know, obviously, if you do your homework and due diligence, if the city is promoting something, if infrastructure is going to better, is there a business district or a bit in Germany, is there an extension? All these kind of things are very, very critical in our homework. The second thing is obviously, what about the structure? And there are some of my clients have also an emotional view still on real estate in terms of architecture and whatever, and that's my biggest issue, because very often there are very intriguing facades still. But for example, if you have urban retail on the ground floor, the retailers have completely changed what they want today from their spaces. And you cannot just simply say, I have this old space and I will have the quality to do this in the future, unless the structure can be changed. The same is with the office. Everybody knows this, flexibility in the office space is very important. Can you offer this? And on one or two occasions, we ended the due diligence because of this, because we could not get our arms around this. Obviously, we're not a professional developer who can tear down a whole building and do it new, but we're thinking in terms of refurbishment and have done so. So that is important. Can you really change this? And then, for me, a little bit more critical is actually do your homework on the history of the building. And we find very often that the previous owner have done not a good job, and not because we are smarter, because they had a different focus, they were not present locally, they had the wrong managers, or they simply didn't saw the signs changing. I'll give you an example. Typical German office tenant have in the past been very stable and long-term and a high renewal rate. This has completely changed. I mean, everybody is renegotiation, everybody wants break option, all these kind of leases get shorter. And some of my clients at least have not had this experience. They kind of, then said, okay, go away, and then I go to the market, find a new tenant. And they were very surprised for the first time that they have to be, swimming naked out there, and it didn't work. So I think the history of an asset is important, and all with these parts, if you work good, it works well. And for us, we also have to remind ourselves always what we can actually do from asset management from Frankfurt, where we are based, and what we do have to have locally on the ground. And I agree that what we heard earlier today, picking the right execution manager is very essential, and to not overestimate what you can really do from the distance. And to come to the green part of it, there has been many discussion about, is the value of the building rising if you have a green certificate in one way or another? Are the rents rising and something? I personally would not go both of these routes. I just say assets have to be green. I mean, it's just like years ago nobody cared for architecture. Today everybody cares about architecture. It's one of the things you have to have on your list. And be it because the tenant really wants it, because it's a corporate tenant who says, I want this as my philosophy and corporate values, or it's simply because of the costs, and I think the cost, the expenses, matter and will rise further in Germany, and so this is critical that you have this just as part of the toolbox. An interesting question to the audience or to my colleagues here is, do you always want to have a certificate? Because the certificate is somehow like a stamp saying 2010, and it's not only on the elevator as we all knew it, it is sticking there, and then 5 years later everybody said you have from 2010. 5 years ago, 5 years was not too much, but today with the fast evolution, so I'm hesitating a little bit with this focusing the attention too much on this date. I would rather say have a continuous green attitude to the building.
I think from my perspective, it's the point you touched upon is operational costs, occupation costs and operational costs, and mitigating the cost and enhancing efficiency. I would concur with you. You don't need a date on one of these certificates. From an institutional viewpoint, if you are an insurance company or a pension fund, it's easy to tick the box to your investment committee. If you have a BREEAM or you have an environmental certificate, it is not. And unfortunately, for me, it's not a deemed requirement today in the majority of investors. I think, though, it is more a requirement from an occupier. And I think what we're seeing in the German market now is that sensitivity to the costs of occupation being far greater, and in some respects driving this than the actual owner of the building. Just my observation.
I couldn't agree more.
Torsten, Douglas pointed out that he doesn't see major rental growth in Germany. Where does growth come from then in Germany? Or is there none to expect?
I said moderate, limited.
That's, not to state the obvious, it's of course depending on where you are and which city, which industries are driving this. We have in the various office markets, of course, places which are catching up. And as I'm located in Berlin, I've seen the Berlin market catching up to expectations which were there already 10 years ago. So that was modeled in lease agreements then in a way that maybe optically it looked like what people had in mind, and today we're achieving those levels. These levels are comparatively low again compared to other markets that have a stronger industry. And I think, again, we have the Munich market also in office being the outstanding one, because if you see relocations of DAX companies like they had with Linde coming from Wiesbaden, this brings in many other companies who are operating around it, and you see whole neighborhoods and areas being positively affected and seeing a real rise in rents. So this is, let's say, one of the examples that you can see in already a pretty mature market. Now, The other thing that, of course, should affect the whole country, and that we're all waiting for and seeing the opposite in the press, is at one point a bit of inflation should occur. But at the moment, it's all the fear of deflation. So I think there will be a point when that breaks, and that's what affects all markets. And then just to come back, I'm not negative on the rent of the secondary markets, the tertiary markets. My remark was more, it's difficult for the international investor to get the access. I'm positive because the same what I just said about Munich does apply to secondary and tertiary markets, where you see new plants opening, companies relocating, staffing up, and fortunately it's a quite lively place.
It is very much, as you say, it's knowledge more than anything else. I appreciate that. Yeah.
James, with international law firms and international investors coming to Germany, do you see also innovative deal structures coming into Germany, like, for example, forward funding deals or profit erosion deals, which have been common in London before?
So short answer to that is I haven't yet, but it depends how the market evolves. There's nothing about the German legal structure or the way deals are done that would preclude those types of transactions happening. I mean, Germany has got sort of freehold ownership. It's got long leases through the heritable lease rights and things like that. So that does give the sort of flexibility you need to structure around those deals. I mean, I think from an execution point of view, most European jurisdictions are pretty similar. You know, if you're buying an asset or doing a share deal, most of the things you think about are, pretty standard. I think everywhere has something that's a bit different. So I think for international investors, I've just listed a few things which I think they've raised eyebrows, if you like, when going into Germany, things which surprise them. Things like recoverables, the roof and structure. That's something which international investors, particularly if they've modelled 100% recovery, that can be a bit of a surprise. At the risk of upsetting some august people in the audience, notarial costs are really very big, and something that people who are not used to that system will be quite surprised at. Also something which I think German investors seem to take for granted, because apart from, as I learned, 2 cities, most cities haven't got any money. Municipal preemption rights that crop up, where German investors just ignore them because they'll never happen. But if you say to an international investor, oh, don't worry, you're going to exchange your contract, but somebody's got to go and offer it to the municipality, that can be a bit of a shock, depending on when it's raised in the process. And my personal favourite, being a lawyer and therefore a bit techie, is what's called lease form requirements, because trying to explain to an international investor that how the certain pages on the lease, or a variation to a lease, or something assigned, can have a massive implication in that your nice 10-year fixed-term contract is in fact got a 9-month break right on it, can cause some consternation. So I think, and actually, that, although I think for a lot of for people who work in the German market, you take that for granted, and it's not really an issue when you sort it out. But you say to an international investor, 10-year fixed term could be a 9-month break, and see them go very pale very quickly. And so it's not an issue, it's the way we do it. It's that I think is the one that's given me the most sleepless nights over the years, even though it sounds quite small. And then the last thing is, and again I hate to raise this, given I know there's at least one tax lawyer from the previous panel, is understand the structure. Sort of ask a tax lawyer what trade tax is. Is it scary in terms of what you're doing? Is your structure that you've set up to avoid or minimise real estate transfer tax, is that going to give you other issues? And again, sort of, because trade tax is something that is German specific, it's something that international investors will not have come across elsewhere.
Douglas, we heard that during the last 150 major deals, most of international investors lost out. Where were they coming from? What is the international investment community in Germany? Who is looking at Germany?
Well, let's just take up the last 3 months. Who have we seen? We've seen the Norge Bank, the sovereign wealth fund with AXA. We have beginning to see the Koreans in Munich. So I think first and foremost is the sovereign wealth funds and the national funds from the Middle and the Far East. So that's the first point of call, and they're looking at core product. We then still have the hedge and leverage funds either indirectly through the NPL market or through the opportunistic investments which come through houses such as our own. There are a few of those. The part of the international market which we're not seeing is the core plus. The core plus investors for some reason seem to steer away from Germany, which I find quite astounding because Germany is a perfect core plus market, both in terms of realistic leverage expectations, but also with active asset management, you can get some very good returns across the sectors, whether you're dealing with residential, my colleagues earlier on, office, or indeed in other sectors we'll be talking about later. So I think for me at the moment I'm seeing a dumbbell approach of core, which is principally the sovereign wealth national. We're beginning to see some insurance companies coming through from a European perspective, and then we still have those value-add opportunistic guys who keep on searching the market but unfortunately don't find those deals that they dream of. One of the things I would say is, and just touching on a couple of points here, a number of people are now looking at Germany, and access of product is a difficulty. There is no doubt at all about that. And one of the things we're finding across our client base, indeed no doubt from a family office, is trying to find the product because of the competition locally from the local investors. So one of the ways we're now beginning to see things is possibly, we touched upon it, which was forward funding as a way of getting quality product. And that's something which we may or may not touch on later, but something for colleagues in the audience here to think about.
Stefan, would you say that there is an over-allocation in Germany into core, or is it just because there's a lack of alternative products?
I rather would say that the people have not the same core definition always, and I think core sells very nicely, and it comes out of the 2008-2009 environment, and it was justified. And today, you know, there's lots of new product, new development sold as core, where I would not underwrite as core. Just give you an example. Not to name any specific developer, but for me, a refurbished, nicely refurbished product with only 5-year leases on, which are bought into by the developer and packaged and then sold as a multiplier of 20 in Hamburg as a core product, for me is not a core product. And we have conservative money, and this conservative money can obviously say, well, the evaluation is good and I have the cash flow, but he will have his big surprise after 4 years when the tenant comes already in terms of early prolongation, and it will drop massively because the money did not come from the tenant, it came partly from the developer. And I think that has been a good game for the developer, and I think when the market doesn't change, it will go further. So this is kind of built to core, so to speak, but I would really look very critical on if that rents are sustainable. And in one case we found out about this development because that developer approached one of our tenants and gave him an offer which was so insane. And so we saw the details, and lots of people don't look at the details. They say it's a great product, it's what the Americans would say flight to quality, people want to upgrade and all these kind of things, yes. But the Germans are very cost sensitive, and the rents, as we heard, are moderate. And if you look in Hamburg or Frankfurt 20 years ago, the rent, and then today, not too much difference. So I think you have to be cautious about this. From the developer point of view, or if you would do a forward funding approach, it could make sense because you might get exactly the product you want. And I think that's what you pointed out, that you get something which has a really nice floor plate and where you think it's a real sustainable development, and very often that's not the case. Also with refurbishment, not the case. So I think there's an opportunity, and from the Frankfurt market, I would say there's a special opportunity in looking at assets which are just worn out. I mean, there's a lot of stock which are good situated, but they just haven't been creatively managed. Look nasty, have no ceiling height and all this. So I think there is potential. However, I compare this very nicely always to Chicago, where we invested, and the Chicago market is also a market different from New York, for example. There's no growth, basically. It is always flat. And it's always the new product kicking out the older product. And in that sense, if you have a nice newer product, you will be successful, even these markets where tenants are maybe rare.
Well, if we take an international investor who has probably put together a portfolio in 10 different countries. For him, it might be difficult to swallow that in Germany he has to look into 10 different cities again. Torsten, if you only go to Berlin, to the capital, is that a good approach, or to leave the rest of Germany behind, or do you lose out something?
That depends on which factors you take into account. Certainly, the whole acquisition process is more fun in Berlin than in some of the other cities. If you look at value development, I'd say in my business lifetime, and I don't intend to retire anywhere soon, I will probably not see excess in office rent in Berlin. The reason for that being that in the inner city part of Berlin, we can build the entire office stock of Frankfurt, which just means that whenever prices are really getting to levels which are very attractive, someone will build. Now, this still means that in between there are opportunities to buy, but for someone and to build, and there's always special locations, refurbishments. So from that point of view, it's interesting. But otherwise, in the German office market, to only look at Berlin, the poor city without any DAX headquarters, without any real industry, I wouldn't advise. But I would certainly, on the search of the product, not leave it out.
Okay, Douglas, what do you think about sale and leasebacks? Is that a good way to enter the German office market?
I think first and foremost it's more of a covenant analysis than it is a real estate analysis. We clearly, with one of our key clients, have been involved in a lot of sale and leasebacks, as you can appreciate. The market has taken the product in particular because of the quality of the office, but also for the underlying covenant. In this case, it's Deutsche Telekom. I would have to say it's a culmination of structure of what you're offering from the lease perspective, the location of the assets, and the quality of the covenant. I do not see this as a growth market. There are a number of German DAX companies and medium-sized corporates who are now repositioning their corporate real estate portfolios. Germany has historically not done that. It's had a hidden reserve in their corporate real estate. We're now realizing that that reserve is possibly no longer valid because we need the cash flow in the corporate companies in Germany. So there might be some changes in the pattern of sale and leasebacks, but I don't see it to be a growth area. We have a number of very large international companies who look for such assets, or investors, sorry, the companies. But my personal view, it is not one I would look at too strongly. It might be my colleagues in the logistics sector might have a view on that one later this afternoon, but not from an office perspective.
Okay. Stefan, you were talking about development. Would you advise to do a speculative development today? And you're coming from Frankfurt.
If you're very bullish about your product, why not? You can always do it. But for my client, it probably would not be the right thing, because the office market, as we heard before, is not growing too much, and there's a lot of new product coming in. Obviously, there has been cases where also Frankfurt has seen growth. Currently, with thanks to the European Union, we are experiencing the fact that the European Central Bank obviously has also attracted the supervisory authority for the bank, the new banking facility. 1,000 people are coming now to Frankfurt. Obviously, the families, the lobbyism, and so on. So there is always these moments where you could capitalize on. But if I would do this, I would rather do this on a mixed-use product, personally, where you have a retail anchor and maybe even some apartments. Because mixed use, we didn't touch too much on mixed use so far, but I think there's much more openness to mixed use, and the city loves it, and also investors have changed their opinion about mixed use.
Can I just touch on this development, because we have a lot of involvement in the development side. First and foremost, 70% of all developments in Germany are pre-let. So the volume of actually speculative development is extremely low, and that's one of the reasons why we don't have the volatility in the availability of quality prime office space. There is, from our perspective, an interest in development as a way of capturing prime assets, and we will see in the coming year or 18 months further people wanting to go that way to obtain assets. And whether it is on a bilateral basis or whether it is in a pool basis, let's wait and see. But I personally think that Germany is primed for controlled development in the right locations, in the right sectors, and I don't disagree with your mixed use. I think, but that's the German city mindset. But I don't think speculative development is a word which we really use in Germany. We use controlled development, I think is the better way of describing it. But I do think there will be a role for it, and for a house such as ourselves, where we have a significant corporate client which we reposition their assets often in the center of cities, it is a natural way to create value.
Okay. I'll put my last question to the panel now. I'm sure there are plenty of questions in the audience. Feel free. Well, please.
Yes, so one question regarding the listed property markets. What's your opinion from the international perspective? I mean, we have seen a large increase of activity in the residential listed property market.
Well, we saw the Prime and we saw the Oak Tree, as you saw, and Prime and Oak Tree was more a solution for Oak Tree to exit their investments, albeit I give the guys credit for putting the two assets together. Whether it was economically correct from a Prime shareholder, who knows. But you're right, we're not seeing other asset classes. It is rumoured, and possibly Charles is better than me, to hear that we might have a large, significant retail entity come into the market in the near future. I think Germany is missing a trick. We have 5 REITs in Germany. Those REITs have, with all due respects, failed in terms of growth. I think that the market historically hasn't taken to listed real estate stock, the exception being residential because of the REIT arguments which the government have put out. My personal view is that unless we drive the listed market, and I mean as practitioners, both from an advisory, as an owner, I think the market will not grow. I think it'll stay in the London market and possibly stay in Paris as well. I would love to see, from my own perspective, healthcare REIT, which I think would be fantastic for the German market, as I would like to see retail REIT, which Cerberus is rumoured to be doing. So my view is I am somewhat negative about the ability outside residential for listed stocks, but that's just a personal view, and I'm not an investment banker.
But let me comment on that. I think there will be activity similar to what you commented on the deal of Oak Tree exiting their holdings. I believe there is the rumor of a few transactions being discussed currently. Whether that's a wise thing to do for the investors, I don't know, because it's depending on the individual terms of each of the deals. But we've seen a bit of closing of the gap between NAV and the share price, also in listed office companies. Of course, what has not happened there so far yet was also there a distinction between the management and the ownership of those groups. And I think if the office market of listed real estate shall come into some life, investors will need to do that more carefully than they did in the past, where actually they were backing developers where it was just an exit for their products that they couldn't find other exit routes for, etc. Once that's scrutinized more carefully, I think there's a possibility for life also for the office market in a listed form.
My view is the valuation has to be looked at. There is a big suspect between the red book and the market value. And until you actually have that correlation identified better, I think that's where the problem is going to come.
All right, my last question to each of you is how would you advise to spend 100 million euros in Germany? James, for you, I may modify it because you might suggest to invest it into lawyers' fees. James, what do you think is an international investor seeking for who has 100 million euros to invest?
Well, just reiterating what I said earlier. First of all, get the tax right. That's absolutely key. And secondly, find out what you don't know. Okay. So, Torsten, you want to start? How would you advise to invest 100 million euros in Germany? Regionally, product-wise?
Depends on your mindset. If you're up for a swing and some frizzy feeling on the way, going to the Frankfurt office development market. If you want something more stable with an opportunity, select a few houses in Berlin.
Douglas?
I've got 3 sectors to go at, so I'm going to split my 100 million into 3. I would put 30 million into Fachmarktzentrum. I think the institutionalization of that retail asset class is an area for growth in the German market. I would go into the regional office market, the repositioning in the top 20. And finally, because I have a passion for it, but I think sustainable value, is the medical office building sector. Look at German healthcare real estate. I think sustainable long-term value creation opportunities. So I would put a third.
So, with other words, speaking from an office panel, you would only invest a third into offices.
Correct, because I think there's no value in the core locations to create at the moment.
Stefan, can you top this?
Again, depending on what is your aim and looking at maybe this kind of families, I understand, we would also not put all in office, surely, and the 1/3 rule is a nice rule, but we would make it a little bit maybe differently. We would go actually in mixed use, almost 50%, where I would have some retail, some office and apartments, and I just don't care how it looks unless it's function, because we are not scared about managing mixed use, and I think everybody will experience that it's very stable in Germany to have such a product. And I would have a core satellite concept where I would have at least 70% in this top 5 cities, and 30% I would try to convince the investors to go to 1 or 2 cities. For example, Nuremberg is a fantastic regional town for retail. It draws a lot of capital in, and I would make 1 or 2 testing grounds for assets around 15 to 20 million.
Well, I myself, I would go into one deal of 100 million. I would choose one of the 3 cities, Berlin, Hamburg, or Munich. And I think it should be an office deal. If there was a retail element on the ground, not to care. But I think today it is beneficial to be able to go big, because up to 30 million you're in a stiff competition with private investors, which sometimes have also irrational views on prices. Still, at the moment, there is not such a big market for huge deals, so I think it would give you an advantage to go big. Well, I think we can conclude that offices is a good way to enter Germany. I think there is a multitude of possibilities, probably too many in the first instance. So if you decide to go, you really have to go through a selection process, regionally, product-wise, and choose with a partner where to concentrate and focus. But I think focusing pays out. Thank you very much.